Hey, Morgan. Bank of America announcing that it has authorized a $40 billion stock repurchase program. You can see those shares up about 0.5% on this news. The company says the current program as of June 30th has about $9.1 billion remaining. And this program, the new one, the $40 billion repurchase program, is effective August 1st, and it will replace the current program. So again, you can see shares of about 0.5% on this $40 billion buyback announcement.
Imagine waking up to find that $41 trillion, yes, trillion, had suddenly evaporated from global markets. Sounds like a movie plot, right? Unfortunately, it's not. This is the jaw-dropping alert just issued by Bank of America, and it has investors everywhere on high alert. The warning doesn't just hint at economic turbulence. It points to a potential global financial unraveling that could hit everything from Wall Street to your personal savings. With shifting capital flows, ballooning U.S. debt, and rising geopolitical tension, the stage is set for a high-stakes financial reckoning. So what exactly is driving this risk? Let's break it down. Bank of America's recent market analysis has shaken the financial world. They're warning a massive $41 trillion in global assets could be vulnerable to sudden devaluation. That's nearly double the size of the U.S. economy. And it's not just theoretical. This figure represents real wealth held in equities, bonds, and other financial instruments that could plummet in value if investor confidence collapses. According to BofA, we're facing a perfect storm: high interest rates, runaway debt, dollar decline, and rising geopolitical conflict. It's not one thing, it's everything, all at once. Investors are now spooked by the growing instability, prompting a dramatic reallocation of capital. Safe havens like gold and emerging markets are gaining attention, while traditional U.S. assets, long seen as rock solid, are being quietly offloaded. BofA's tone is urgent. While they stop short of calling it a guaranteed crash, they're loud and clear about the risk. If capital flight intensifies, the dominoes could fall fast, and once momentum builds, recovery becomes painfully slow. For decades, U.S. Treasury bonds and the dollar were considered the ultimate safe havens. Not anymore. Investors are beginning to question America's ability to manage its towering debt and political polarization. The shift is subtle, but unmistakable. Hedge funds, sovereign wealth funds, and even central banks are starting to reduce exposure to U.S. assets, reallocating funds to emerging markets, gold, and alternative stores of value. This erosion of confidence is critical. As money exits the U.S., prices of bonds and stocks face downward pressure. Yields climb, borrowing gets costlier, and the economy slows. Why the flight? High interest rates have pushed debt servicing costs to historic highs. Add in global tensions, from U.S.-China trade disputes to Middle East unrest, and the safe label begins to wear thin. This isn't panic-driven, it's calculated risk management. But if too many investors move at once, it creates a rush for the exits. And that's when we stop talking about risk and start talking about collapse.
Welcome back to Power Lunch. The Aspen Institute's annual Economic Strategy Group meeting is underway, where leaders in business and public policy are gathering to promote solutions to the economic challenges in the country. Our Andrew Ross Sorkin has been reporting from there all day and joins us now with a special guest. Andrew.
Good morning to you. I should say really good afternoon. Joining me right here in Aspen is Bank of America's CEO, Brian Moynihan. And I originally planned to talk to you about the economy, and I still do. But I have something that was not on my bingo card this morning because we talked to President Trump on Squawk Box about this executive order that he's planning around banks who he thinks discriminated against conservatives. And your name came up. And so I just wanted to show you what he said and wanted to get your reaction to that.
What happens is I call up Bank of America routinely because when I was president, this was after I got out, by the way, I call up Bank of America routinely, and I speak to him, and I speak to a couple of people, and they have zero interest. Brian was kissing my ass when I was president, and when I called him after I was president to deposit $1 billion plus and a lot of other things, more importantly to open accounts. And he said, we can't do it. No, we can't do it.
The U.S. government's debt has now crossed $35 trillion, more than the entire annual output of the American economy. This staggering number isn't just a headline, it's a growing structural threat. As interest rates remain elevated to fight inflation, the cost of servicing that debt balloons. In 2024 alone, interest payments surpassed defense spending. Bank of America warns that this unsustainable trajectory is turning away investors who once trusted U.S. bonds blindly. The fear is simple. What happens when Washington can no longer find enough buyers? If major foreign holders like China or Japan start dumping treasuries, bond prices would tank and yields would soar. That could send ripple effects through everything: mortgages, credit cards, student loans. Suddenly, average Americans would feel the weight of Washington's borrowing spree in their daily lives. And that's just the beginning. Higher interest rates choke business investment, slow job growth, and threaten recession. The debt bomb isn't ticking quietly anymore. It's loud, it's growing, and it's dangerously close to detonating. The BRICS alliance, Brazil, Russia, India, China, and South Africa, isn't just symbolic anymore. It's reshaping global finance. Their shared goal: reduce dependency on the US dollar, and they're making progress. More trade deals are being settled in local currencies or new frameworks like China's digital yuan. Even Saudi Arabia, long a loyal partner in petrodollar trade, is signaling openness to alternative currencies. Why does this matter? Because every transaction that bypasses the dollar erodes its dominance, shrinking demand for US assets and weakening America's global financial leverage. Bank of America flags this as a major fault line in the current system. If de-dollarization accelerates and large economies pull back from US debt and currency holdings, it could spark a liquidity crisis. This isn't theoretical. The shift is already underway. Countries are preparing for a post-dollar world. And if too many leave the system too quickly, the financial scaffolding holding $41 trillion in value could start collapsing. Slowly at first, then all at once. Beyond the regulated walls of traditional finance lies the shadow banking world: hedge funds, private equity firms, and non-bank lenders controlling trillions. These players operate with limited oversight, creating enormous risk in times of market stress. Bank of America's warning includes a chilling reminder: systemic collapse doesn't always start in plain sight. A major hedge fund facing margin calls or a sudden liquidity crunch could trigger rapid asset fire sales, just like Lehman Brothers in 2008, but with even greater reach today. The issue is opacity. Nobody knows exactly how leveraged these entities are or how entangled they've become in global financial plumbing. If confidence falters and asset values drop, dominoes could fall in seconds, not days. This hidden ecosystem is massive, complex, and largely unregulated, and that makes it incredibly dangerous in a fragile environment. If the shadow sector stumbles while central markets are already bleeding, it won't just be a correction. It could be a financial avalanche that even governments can't stop in time. The US bond market is the bedrock of global finance, but that foundation is showing cracks. Bank of America highlights a terrifying possibility. A large-scale sell-off by foreign holders could trigger a global chain reaction. Imagine China or Japan unloading hundreds of billions in treasuries. Bond prices would plummet, yields would spike, and borrowing costs across the US economy would soar. That shock wouldn't stay contained. It would hit mortgage rates, credit cards, student loans, any debt tied to interest rates. Panic would ripple across financial systems as banks scramble to stabilize balance sheets. Pension funds, insurers, and retirement accounts, heavily reliant on bond stability, would also take serious hits. Meanwhile, global markets watching from the sidelines would follow suit, leading to mass capital flight, collapsing currencies, and rising inflation. It's a self-feeding cycle, one spark away from ignition. Once confidence breaks and panic spreads, markets move faster than policymakers. And as we saw in 2008, speed is the enemy when crisis control is too slow. This isn't just a Wall Street story, it's a Main Street disaster in the making. Bank of America's warning underscores a painful reality. When markets crash, it's not hedge funds that suffer first. It's retirees, families, and everyday workers. Pension funds and 401ks are deeply invested in stocks and bonds. A sharp decline, even 10%, could wipe out years of gains, leaving millions scrambling to replan their futures. Mortgage rates, already elevated, could spike further as bond yields surge, putting home ownership out of reach for many and pushing current homeowners toward financial strain. Consumer credit tightens, loan approvals vanish, and household debt balloons. Small businesses struggle to access capital, leading to layoffs and closures. This is how an abstract number, $41 trillion, becomes real. It's not just about charts and spreadsheets. It's about the job you lose, the retirement delayed, the home you can't afford. That's the true cost of a collapsing system, and it's why this moment feels more personal than ever.
You heard it. Were you watching TV when this was happening?
So I got up early because we're on East Coast time. I was working out and I was watching your wonderful show, and he came on, and I'm telling you, I'm still trying to unsee some of the visuals that he created with his commentary. But look, the president's after the right thing, which is the laws, rules, and regulations around our industry became used to cause things to happen. It's whether it's BSA, ML, whether it's KYC, whether it's reputational risk, and you heard Tim Scott quote about it. It is right to go look at these rules, because at the end of the day, they are causing decisions to be made that can be looked at in retrospect and made differently. We should get these rules right. So our company, my colleague companies, the industry has been working with the Treasury Administration today, in this administration, trying to figure out how to get these rules balanced so that we're not subject to this swinging back and forth in this after the fact look. So the president's on the right issue. He asked me about it in Davos. We were there. Right. He asked me, he talked about it this morning, and I welcome getting this fixed. At the end of the day, we bank 70 million consumers, more small business than anybody else, 12 million small business, more middle market companies than anybody else. We bank everybody. But the reality is we want to make sure that the rules and regulations don't cause decisions to be made that then are looked at in the aftermath and dealt differently.
In times of financial fear, investors seek safe havens. But in this volatile climate, even the safe options come with serious risks. Bank of America reports a growing shift into gold, commodities, and even cryptocurrencies as institutional investors flee traditional markets. Gold prices have surged as central banks ramp up purchases, signaling a broad loss of confidence in fiat currencies. Meanwhile, Bitcoin and other digital assets have seen renewed interest, especially among younger, risk-tolerant investors looking to hedge against inflation and systemic collapse. But these assets are not immune. When panic spreads, volatility doesn't disappear. It gets redistributed. Gold can stall or crash when liquidity dries up. Crypto, often praised for independence, still reacts violently to macro shocks. In a crisis, safe havens can become wild rides. The problem: there's nowhere perfectly safe when confidence breaks across the board. And if capital flows into these assets accelerate, they might not stabilize the system. They could become the next bubble to burst. The $41 trillion threat isn't confined to U.S. borders. If confidence collapses, the shockwaves will slam emerging markets first, crashing currencies, spiking inflation, and triggering capital flight. Even Europe and Asia, heavily tied to U.S. financial systems, wouldn't escape unscathed. The BRICS nations, despite pushing for de-dollarization, still hold large volumes of U.S. debt. If panic forces a fire sale, global liquidity could evaporate fast. Add fractured geopolitical alliances, and coordinated response becomes nearly impossible. In a hyper-connected economy, no country is insulated. When trust dies at the top, the tremors ripple down to every corner of the planet. Yes, the system has safeguards, rate cuts, emergency liquidity, IMF coordination, but none are foolproof. Inflation limits the Fed's flexibility. Political gridlock stalls decisive action. Global cooperation, nearly non-existent. And once investor psychology turns, even strong policy responses might arrive too late. Preventive action, reducing deficits, rebuilding alliances, was needed years ago. Now, it's about racing against time. Once confidence collapses, markets spiral on emotion, not logic. Bank of America's message is clear. The system is fragile. The spark could be anything. The damage could be everything. So hit that like button and subscribe. We'll be here breaking it down before the next headline hits.